Okay, class, in this lesson, you are going to learn about loans and be able to compute monthly payments using both a spreadsheet as well as a formula, and then also be able to compute interest on loans. Okay, so let's go ahead and get started with some definitions and understanding of what loans are and the types that are available. All right, so here are some things that you need to know before you take out a loan. So whenever you borrow money, you must sign an agreement called a promissory note, which states the conditions of the loan, and it contains information that the creditor is required to state as required by the Truth in Lending Act. The Truth in Lending Act has a lot of interesting information, and you may want to read up about it. It is fairly long, but it does tell you some of the requirements that, actually all of the requirements that creditors must abide to. And there are some lines that creditors will cross, and as consumers, if we're not educated on it, then they will take advantage of you, okay? Some of the things that are included are a principal, so they have to declare the principal amount, the APR, which is the annual percentage rate, monthly payments that you need to make, the number of payments that you need to make as well, and then when the interest is due for each of the payments, as well as fees for any late payments that may occur. Now, the loan amount that you borrow is called the principal, okay? And then the interest rate that you pay is given per year, and as I indicated, APR stands for annual percentage rate, okay? So whenever you see a percentage noting APR, that's the percentage for the entire year. However, the interest rate that you're going to calculate on a monthly basis will be a little bit different, and I will show you that in a couple minutes. Okay, certain things to note. Not all loan agreements are the same, okay? So each promissory note describes the features of that particular loan. Okay, so here are some terms that you should be familiar with. Cosigner. So this is a person that agrees to pay back a loan if the borrower is unable to do so, okay? So for example, people without an established credit, especially those that are younger, graduating from high school or college, when they want to borrow money, there's not enough credit information on them, and so typically they will ask a parent or a relative or somebody that they trust or that trusts them to be a cosigner. And what happens is that the cosigner guarantees that the loan will be paid back in the event that you're not able to. Okay, so that's what a cosigner is. And then life insurance, this is a creditor, life insurance is where a creditor often requires a borrower to have life insurance that will cover the loan in the event the borrower dies before the loan is paid. So we all know what life insurance is, but sometimes a creditor will require life insurance sort of as a quote-unquote guarantee in the event that you're not able to pay back the loan. Okay, prepayment privilege. This means that it allows the borrower to make payments before the due date to reduce the amount of interest. This is a very good feature to have, especially if you're trying to minimize the amount of interest that you're paying on a particular loan. And then prepayment penalty. This is an agreement that requires the borrower to pay a fee if they wish to pay back an entire loan before the due date. You'll want to avoid getting into loans where a prepayment penalty exists because it prevents you from paying back the loan before the due date. One example of this is leases. So if you lease a car, you're obligated to pay the full amount, and if you decide to prepay in advance, you may end up paying a penalty for that. Okay, wage assignment. This is a voluntary deduction from an employee's paycheck used to pay off debts. Okay, so if a debtor's employer, so if where you work, your employer is willing to do this, and the creditor agrees, then the loans can be paid off using an electronic transfer from your pay. Okay, and then wage garnishment. This is an involuntary form of wage assignment, often enforced by court order. Okay, so the employer has to deduct money from your paycheck to pay the creditor. So this is essentially against your will because the court has ordered this to take place. And then balloon payment, this last monthly payment on some loans can be much higher than the previous payments. These high payments are called balloon payments. So in other words, let's say you have a 12-month schedule that you're paying back on a particular loan. You could have small monthly payments from month 1 to month 11, and then month 12 would be one large payment that pays off the balance of what you borrowed. That's called a balloon payment. Okay, now an organization that extends loans is called a lending institution, and they are businesses that make profit by charging interest. Okay, for example, banks are could be lending institutions, and this is where most people apply for loans. They go directly to their bank. Savings banks offer good interest rates, but require loan applicants to have good credit ratings. Okay, so commercial banks are banks used by businesses, so they have large amounts of money to lend. And they also require a good credit rating. And then credit unions is also another lending institution, and they provide financial services for members only. Okay, so in order to take advantage of the products offered by a credit union, you'd have to be a member. If you are a member, you could be a member because you work in the same office or in the same profession or live in the same area. There are some other requirements depending on the credit union, but there are some criteria used to allow members to be part of the credit union. So members deposit money into a credit union just like you would in a traditional bank, and then this money is then made available to other members who apply for loans from the credit union, and they're able to provide these loans at a lower interest rate than that of a bank because credit unions operate as a nonprofit organization, and because of that, they're exempt from certain federal and state taxes, and so they have more money available and can afford to reduce the cost of these loans. Consumer finance companies are businesses that primarily lend money to people with poor credit ratings who usually can't get a loan anywhere else and are charged high interest rates. And then life insurance companies make loans to their policyholders only. It's sort of like a credit union. The amount that can be borrowed is based on the amount of life insurance purchased and the length of time the policy has been held. The interest rate is good because the life insurance company is not taking much of a risk if the loan is not paid back because it can be deducted from the insurance benefit when it is paid. Okay, and then pawn shops are another type of lending institution. They're known for small, quick loans. So people who need money basically leave personal belongings, which are called collateral, with a pawnbroker in exchange for the loan. And then the loans are paid back usually in a short period of time, 30, 60, or 90-day loans. And then when you return the principal amount and the interest charged, then the collateral is returned to you. Okay, and then payday loan stores, again, another type of lending institution. They offer a payday loan. This is a small loan taken over a very short period of time, usually a few weeks or less. And so you as the borrower agree to pay back the loan in full on your next payday. The APR that is charged is really large for these types of loans, but in exchange they're available to you, especially if you've got poor credit ratings. In order to get this, you have to show proof of employment before they're willing to provide that loan to you. Okay, and then last but not least, you may have seen loan sharks or heard about loan sharks in the movies. They charge extremely high interest rates, and they don't necessarily check your credit ratings. Just know that loan sharking is illegal in this country. Okay, all right, so regardless of where you shop for a loan, the Equal Credit Opportunity Act requires a creditor to treat you fairly. If your application is turned down, you are protected by the Fair Credit Reporting Act, or FCRA, which says that the lender must give you the reason in writing for the loan denial. Okay. All right, so that concludes the definition. Hopefully, you've got a better understanding of these terminologies, because as you work and start to borrow loans, these are terms that will be used by lending institutions and creditors. Okay, so let's work through some of these problems, okay? So in this example, we are to determine the monthly payment for a $4,000 two-year loan with an APR of 4%. Okay, so how do we do this? Okay, so one way to do this is to use a spreadsheet. So let's go ahead to the spreadsheet. Okay, so what you'll see is the function to calculate the monthly payment based on the rate, term, and the amount, which was given to us, okay? So in the spreadsheet, we're gonna go ahead and type in equals PMT, and then we're gonna put in the rate, which is 4%, but remember we have to divide this by 12 because that 4% is an APR, or annual percentage rate. So we want to look at the monthly, so we have to divide this by 12. And then this was a two-year loan, okay? So we have to express this in terms of months. So 2 years is equivalent of 24 months. And then the amount that is being borrowed is $4,000. And we're going to put this as a negative because we are borrowing the money. And if we hit enter after closing the parentheses, you'll see that the monthly payment is $173.70. Okay, so the answer here is $173.70 for example 1. Now let's go ahead and move on to example 2. What is the total amount of monthly payments for a $4,000 two-year loan with an APR of 4%? Okay, so we want to know how much we're going to be paying throughout the term of this loan. Example 2 is related to example 1. So we're going to take the $170. I think it was $170. Sorry, $173. And we're going to multiply that by 24 months. And when we do, we get $4,168.80. Okay, so that's how much will be paid out in total at the end of the term. So let's go ahead and move on to example 3. So related to example 1 and 2, we now need to find the finance charge for that same exact loan. $4,000 for 2 years with a 4% APR. Okay, so we're going to take the total amount that we paid, okay, $468.80, and we're going to subtract the loan amount, okay, and what's left is $168.80. So this is the finance charge, or how much extra we are paying, or the cost for this loan. Okay, now let's go ahead and move on to example 4, okay? Okay, so in this example, Mark has bought a new car, and the total amount that he needs to borrow is $28,716. He plans on taking out a 4-year loan at an APR of 3.12%. And the question is, what is the monthly payment? Now, I already showed you how to calculate this using the spreadsheet. However, we can also do this or find the monthly payment using an equation. And the equation is as follows, right? So our monthly payment is going to equal the principal amount times the interest rate divided by 12. So this will be a monthly rate times 1 plus interest rate divided by 12 raised to the 12 times t, which is the number of years for the loan, power, divided by that same quantity minus 1, okay? So let's go ahead and calculate this. Our principal amount here is $28,716, and the rate is 3.12%. And now remember, the rate has to be converted into decimal, okay? So that means this is going to be 0.0312 divided by 12 times 1 plus 0.0312 divided by 12 raised to the 12 times t. This is for 4 years, so 4 power, and that's all going to be divided by that same quantity. So we have 1 plus 0.0312 divided by 12 raised to the 12 times 4 power minus 1. So when you plug this into the calculator, we will find that the monthly payment ends up being $637.13. Okay, and if you use the spreadsheet to calculate this, you'll see that you'll come out with the same exact answer as well. Okay, let's go ahead and move on to example 5. Here, Natalie needs to borrow $400 until her next paycheck to purchase a wedding gift. She goes to Friendly Fred's loan store, and Friendly Fred lends her the $400 for 3 weeks, at which time Natalie pays it back in full. There's no collateral required, so the APR is relatively high. Fred charges her $70 interest for the 3 weeks. The question here is, what is the APR for this loan to the nearest 10%? Okay, so we have this equation. Our payday APR is equal to the loan interest divided by the loan amount divided by loan length in days divided by 365 times 100. Okay, so let's go ahead and enter our known values. The loan interest is what we are charged, so that's $70. And the loan amount is $400. Okay, and we're going to divide that by the loan length in days. This is for 3 weeks, so that's 21 days out of the 365 days in a year, and we're going to multiply that by 100. Okay, and when we go ahead and punch that into the calculator, we get 304%. 304.17%. And we're told to round this to the nearest tenth, and so this works out to 300%. Okay, obviously a very, very expensive loan. All right, so hopefully that made sense to you. If you have any questions or if anything was not clear, please go back to the beginning of the recording and listen to this again. Thank you.